Okay. Hi, everybody. Welcome to the Endowus webinar series. Let's give it a minute or so that as people trickle in, we can welcome them. Okay, here's a couple of minutes. Oh. Reset. Thank you, everybody, for joining us for the Endowus Q4 2022 portfolio performance review, and then also market insights and an outlook for the 2023 market. Investment Officer at Endowus. And joining me today is Sean Wong, our Head of Investments.
Hi, everyone.
Say hi, Sean. Okay, great. So we're going to get going, guys. Thanks for joining us. So, typical disclaimer as a MAS financial licensed entity to show this. And then also, again, our usual Slido. So the Endowus 2023 is the password. You can type and go. And you can actually vote thumbs up on the questions that you want answered first. And we'll have this code at the top right throughout the session. But please join Slido and then leave any questions there, and we'll take questions and answer them at the end. Okay, so just a quick intro that have not joined us. We've updated the people in the slide to include our latest Endowus advocate, Ben Kang, but also Joanne and Rachel and Lou and everybody's there. And so, Endowus is really about helping individuals and everyone invest better to live easier today and better tomorrow. We're really focused on trying to help individuals build wealth for the future in managing your money holistically, both your private wealth and public pension. We are the first digital advisor for CPF, but for SRS and cash as well. So you can manage everything on the platform. We're backed by some of the leading strategic and global ventures, including from Home in Singapore, EDBI and Singtel, but global investors like and SoftBank and Z Ventures and Samsung, but also UBS, the biggest private bank in the world, so a shareholder and backer of Endowus. We also are very focused on being a total wealth platform. So as you know, we are not about reinventing the wheel. We're not developing some algorithm that's trying to beat the market. We're trying to access the best-in-class funds and portfolios globally through the Endowus platform. So we work with many fund management companies locally and globally. Initially, we started with public markets, passive index funds. Some of these are exclusive and at the lowest cost from Amundi. Really excited about the new range of iShares, BlackRock passive index funds at really low cost. So please check out the new BlackRock iShares funds for S&P 500, for global equity, for global ag and fixed income. We have and emerging markets. So we have a wonderful passive instruments from Amundi and BlackRock, and also the systematic quant product from Dimensional. But we've been expanding our range. So as you know, I think we just came out with a publication that we're the first ones to distribute Bridgewater products, the biggest global hedge fund in the world, but also Millennium and Point72 and other wonderful products are on our platform on the hedge fund side, which have generated good risk-adjusted returns with low volatility over cycles. And then a lot of private market stuff. So Partners Group, private equity, KKR private credit, private real estate, etc. We're working with some of the leading fund managers for multiple different types of products that is needed to build suitable portfolios for all of your needs, including trying to solve for your retirement adequacy. So now I'm going to hand over to Sean to go through the 2022 review. But just before we do that, wanted to highlight the Endowus webinar series on the Endowus 2023 market outlook, which we held on January the 19th. So it's a few weeks ago. But we had a lot of our fund management partners, and you can see the quality of the names there, a lot of the local and global fund managers joining people like Sean and myself and Min and Jamie in panels discussing each asset class, macro, equities, fixed income, and alternatives. So please check out the YouTube channel. You know that the YouTube channel, please subscribe so that you get notified automatically to all Endowus webinars. We have great content here. You know, it's always on, so you can look at it whenever you want. So this Market 2023 market outlook with our fund management partners, and great content for you to look through so that you can have a better perspective on the market. But we'll have some of this in the presentation today. And with that, I'm going to hand over to Sean to discuss the Market 22 performance and also the Endowus portfolio performance as well. Sean, over to you.
Thank you, Sam, and good evening, everyone. So we look at a recap of last year. So essentially, this table charts the performance of broad global equities and global bonds. So each annual calendar year from 1977, so going back the last 50 years, is represented by a dot. And when bonds and equities are up, which is most of the time, 2/3 of the time, you'll see that that's showing up on the top right of the page. And periods where equities go up, and that's on the top left of the page, and bonds go down. So there's some diversification there. You can see the calendar years where this was prevalent. On the right, bottom right, is where global bonds were actually up and equities were down. 2008 is a notable year where bonds provided a little bit of diversification against equities when equities were down sharply. So the reason 2022 was so painful, you can see there the headline, unprecedented year for both equities and bonds on the negative side, was a situation, a year where equities were down significantly, call it 20%, and bonds were down significantly in the excess of 10% as well. So this was obviously very painful for many investors, and diversification didn't really work for that year. If we look at different asset classes, right? So this is the year charted in 4 different quarters. You'll see that equities and bonds are in the middle. Broad bond index, represented by Bloomberg Global Ag, is in green. It was down 11.5% for the year. Broad equities, as represented by the All Country World Index, was down about 19% for the year. The only asset class that was up for the year was commodities, and that's not without volatility, right? Commodities went up strongly in the first 2 quarters of the year and fell down in the second half of the year and ended the year positive. I think we put Bitcoin in here as a point of note as well. It's a high risk asset, and it was down significantly for the year. If we chart line charts on equity performance for every calendar year since 1970, calendar year returns for the last 52 years, what you'll see here is 2022 was a very, very painful year for equities. There's only been a handful of years where you can see over there where equities actually perform more poorly for the year. But what you'll see the chart, it was a pretty consistent downdraft for the first 3 quarters of the year. And there was a little bit of a pickup in October and November, and a little bit of a sell-off in December. Obviously, there was some dispersion among sectors, which we'll talk about as well, and style. Over here, what you can see is value really kind of reversed a 10-year, decade-long period of underperformance. And what you'll see charting different quarters is the ACWI in the middle. So broad equities was down 13%, and actually we charted January as well. So the last 5 weeks of the year, the first 5 weeks of this year rather, things are up sharply. You can see there 7.1%. Last year, there was a strong dispersion between value equities and growth equities. So growth equities, as represented by the MSCI All Country World Growth Index, was down 21%, and value wasn't down very much, just down 5%. So there was significant outperformance for value. Again, the reversal that a lot of the market expects will continue. So there was call it a 16% outperformance from value versus growth, and that again is we're seeing that again this year growth has had staged a pretty strong rebound, which is actually quite surprising as well. So we'll see how that plays out. If we look at different countries now, looking at geographical regions, what you'll see is the different periods, right? So the US, a lot of people are invested in the US. It had a pretty strong run over the last decade. So this is a color quilt of performance of different countries over calendar years going back the last decade. The US shows up pretty prominently. 2014, 16, 18, 19, 21 is a very strong performing market. But I think one of the takeaways here is there's typically a lot of dispersion among different countries over different periods as well. And even across the year, if you look at the different quarters from on the right, 5 columns, you'll see that, from Japan actually being a pretty strong performer last year and being the strongest performing market globally, down 2.5%. The S&P and some of the larger markets like Europe as well, obviously drove the broad equity index down. China, no need to say, was obviously the worst performer. It showed up at the bottom for 2 quarters and obviously for the full year as well. In terms of sectors, so we look at the global equity index and you break it down by the different sectors. What you'll see is energy, as mentioned, was a top performer for the year. So energy as a sector was up 33% for the year. So you can see that on the rightmost column as well. So a couple other observations here. What you'll see is all other sectors were down, which is a bit rare as well for the market. Typically, there's a little bit of dispersion. Value sectors, as represented by utilities, you can see that there. Financials, materials fared a bit better than some of the growth sectors, consumer discretionary, technology, to name a few. And interestingly, I think one of the things that why investors felt a lot of pain is if you look at the sector breakdown by weight. So if you look at the pie chart on the right, over the last 20 years, as everyone is familiar here, technology has grown to be quite a large portion of the broad equity index, representing 20% of kind of global equities. As a single sector, a lot of people have allocated to that, and being down 30% for the year exacerbated that pain. Okay, moving on to fixed income. So what you'll see with fixed income, this is really, going back again 52 years, and you have a line chart for every calendar year where on performance of broad bond index as represented by the Bloomberg Global Ag Index. What you'll see here is really the worst year on, kind of this 50-year chart, and the worst year by significant magnitude, right? If you started with $1 at the beginning of the year, you end up the year, somewhere between 85 cents to 90 cents. So you lost somewhere between 10 and 15%. We saw a rebound, and Sam will talk about this later as well, on kind of how fixed income had a bit of a reprieve as kind of the pace of the expectations of kind of the Fed slowing interest rates hike were kind of put into the markets, and things started staging a rebound. So you can see that in the fourth quarter, and that momentum has continued into the first month of the year. Another way to map it out is really, you look at it, the headline here, fixed income markets had the worst correction in 30 years. If you look at the Bloomberg US Treasury Index, as represented by the green line, you'd think that treasuries would be a safe haven, but because of their slightly longer duration, broadly, they suffered a significant drawdown, right? You look at other periods of pain, the dot-com bubble of 99, 2000, the great financial crisis of 2008, 2009, things were really not as bad as they were in this recent period, call it US Treasury and global ag down high double digits, right? 18 to 24% respectively. Looking at fixed income performance across different sub-asset classes within fixed income, the first thing to note, column all the way on the right, is you'll see that it was extremely painful, right? It was extremely painful to the order of double digits across different fixed income sectors. Treasuries being down 12.5%, they typically are actually slightly positive. If you look at the chart on the left, right, all the different columns on the left, they typically perform kind of low to mid single digits. They really don't have more than kind of 2 years of down markets broadly. And then across the board, whether you're in high yield or investment grade, you also suffered a large drawdown. Notably as well, inflation-linked bonds down 23%. A lot of that was due to things that had longer duration, really suffered a strong sell-off last year. On the back of that, I'd like to go through how the Endowus Portfolios did for the fourth quarter and for the full year of 2022. So starting with the Endowus Cash and SRS portfolios, this represents our best thinking and suited for investors taking a longer term view of growing their wealth and tailored specifically to an investor's risk tolerance. They remain highly diversified and are very low in fees. Both global bonds and equities staged a strong rebound over the last quarter of the year. The MSCI All Country World Index was up 2.4%. You can see that on the fourth row from the bottom. And the Bloomberg Global Ag, representing bonds globally, was up about 1%. On the back of this, our equity portfolios outperformed. If you look at the top row, you'll see the 100% equity portfolio was up 3.3% for the quarter. This was driven by tilts to value over growth, which, as I mentioned earlier, staged a strong reversal in the fourth quarter. For the full year, the portfolios were fairly in line with the index on the equities portion. If you look at the bonds as represented by the 100% fixed income portfolio, so that's the sixth line from the top, it was up 2.8% for the fourth quarter and outperforming the Bloomberg Global Ag by close to 2%, which was up about 1%. So this was driven by overweight positioning within our portfolios to corporate bonds and emerging market bonds. So for the full year, fixed income actually outperformed the broad benchmark for the full year.
Yeah.
In aggregate, the Endowus flagship portfolios actually outperformed meaningfully, the benchmark meaningfully in some cases. If you just kind of look at the 60-40 portfolio for the full year, it was down about 11.6% versus the broad index of 60-40, down 15.8% for the reasons I mentioned earlier. 2023 is off to a pretty strong start for the portfolio. So you'll see there on the left, we've charted both the 4 weeks of January and the full kind of 5 weeks year to date to the latest information available. The portfolio staged a pretty strong rebound, right, in the order of up from 6.7% to 4.2% for the year. So that's a really strong rebound in 5 weeks. And what's interesting as well, if you look at the column all the way to the right, the 3-year annualized performance is actually looking pretty positive for a lot of the portfolios. I think that really speaks to what we always tell investors to kind of stay the course, don't try to time the markets, stay invested, pick your risk tolerance and stay invested into these portfolios.
Yeah, Sean, maybe just to clarify on this, the 2022 full year performance, you look at the equities, 100% equities, minus 12% versus the index of minus 19% almost. So massive outperformance. And now that's really feeding in after 2021 and 22 outperformance, the 3-year annualized numbers are really widening. So I think the flagship portfolio has consistently outperformed the benchmark, which is a very meaningful achievement, I think. Over to you.
Thanks, Sam. So we represent our portfolios visually. So this is a visual line chart of, the last 4 years of performance, right? From January 2018 for both our cash, SRS, and CPF portfolios. If you put $100 into these portfolios at the beginning of 2018 and you held it through the end of 22, the period of 5 years, right? You'll see that portfolios, broadly speaking, remain above water in spite of the recent sell-off. And if we include January's performance as well, things are starting to look pretty positive. Equities have outperformed bonds broadly, but that's not without a bit more volatility. So again, for investors looking for with a slightly higher risk tolerance, you're kind of looking somewhere closer to equities, and then that has that pretty strong performance, but a little bit more volatility. You can see the lines move around a little bit more. So again, stay invested in the long term. It has been a pretty, a bit of a bumpy ride. Market cycles are pretty tight lately, but things have turned out pretty well for investors.
Yeah, I think the other thing to highlight is that obviously the flagship is supposed to do something. It's supposed to be a strategic and passive asset allocation. It's supposed to track the benchmark. So we try to build the best representation of that benchmark exposure, globally diversified, low cost, with what's available in cash and SRS, but what's also available in the CPF portfolio. And so different funds and different underlying products are available for these portfolios, but the outcome, while there's been divergences in the past, is actually very striking that they've all come along and have done what they're exactly supposed to do, which is try to be, in line with the benchmark, and in many cases have actually outperformed the benchmark. Great.
Thanks. Okay, looking at the flagship CPF portfolios, these also saw positive performance in the fourth quarter, ended the quarter and year fairly in line with the benchmarks across the risk spectrum. On the 100% fixed income portfolio, something notable as well. So six rows from the top, you'll see that for the fourth quarter, actually there was about inline performance, but actually for the full year, it outperformed. So the 100% fixed income portfolio was down 9.4% versus the benchmark. It outperformed the benchmark was down 11.4%. There was about a 2% outperformance. This was driven by slightly conservative and shorter duration positioning versus the benchmark. Okay, on the next slide. Endowus ESG portfolios. Again, these portfolios are constructed with managers that select companies that continue to demonstrate how businesses can be responsible stewards and deliver positive societal and environmental impact. This is something very important to us at Endowus, and we're continuing to review and update the environmental, social, and governance data as more metrics become available. And we're also seeing a trend of more funds participating in the space, which is obviously good for investors to have more choice and a deeper market as well. On that, if you look at the fourth quarter that's highlighted in the blue box, you'll see it was a very strong quarter for the ESG portfolios. We saw strong outperformance from both equity and fixed income funds. The outperformance on the equity side was actually quite significant. It was up 4.8% outperformance versus the benchmark, which was up 2.4%. And the 100% equity ESG portfolio was up 7.2%. We also saw a similar pattern for the fixed income portfolio, which was outperformed the benchmark by 3%, up 3.9% for the quarter. This certainly helped to trim the magnitude of losses for the full year. So for 2022, the portfolios ended up close to in line with the benchmarks on a broad basis as well. If you look at obviously January and year to date as well, things are off to a good start similarly as well. So things are up between 3.5 and 7.7% for the last 5 weeks. Okay. On the factor portfolios. Yep. Okay. Thank you. So Endowus factor bidimensional portfolio returns. Again, we have these across the risk to return spectrum in 6 different portfolios. Looking at the fourth quarter performance for 2022, there was strong quarterly performance. There was obviously the equity portion did drive out performance for a tilt to value, and a slight overweight to emerging markets drove majority of the outperformance for the quarter and also for the year. Within fixed income, if you look at the 100% fixed income portfolio, again, there was outperformance. It was up 2.1% for the quarter. And there was the reason for this was a larger allocation to corporate bonds. And this brought the year-to-date performance for the full 2022 closer in line with the benchmark. Okay. Satellite portfolios. Endowus currently offers 6 different satellite portfolios for investors to choose from. These, again, as the name suggests, are meant to supplement your core portfolio allocations, which is where you should look to allocate most of your capital. They also tend to be more tactical, and they're directional, sector, or thematic in nature. There are 2 fixed income satellite portfolios. You can see those at the bottom of the page, and 4 equity satellite portfolios at the top. Most topical are the China equity and China fixed income portfolios. China announcing a pretty kind of surprising reopening at the tail end of 2022 triggered a rally in both China equities and fixed income post a bit of weakness in October. While there was some dispersion in underlying manager returns, the direction has been strongly positive, particularly when we look into January and the first 5 weeks of the year. So you'll see there within the China equity portfolio, there's a very strong fourth quarter performance and very strong year-to-date performance as well in 2023. The China fixed income portfolio unfortunately saw a bit of a sell-off in October and a pretty decent performance in November and December, but it was ended the year slightly negative as well. And it's off to a good start, up 1.4% into this year. Looking at the megatrends portfolio, there was a very strong fourth quarter with performance close to double the MSCI All Country World Index. The portfolio has a slightly high equity beta and a growth bias, so riding an expectation of dovish positioning from the Fed in October and November. I would note that 2022, this portfolio did underperform broad equities, which is not surprising as the portfolio has a growth bias. It is exposed to long-term secular trends. But if you look at the megatrends portfolio out on a 3-year annualized basis, the portfolio still continues to outperform the broad global equities, which is expected. Technology portfolio is a pretty volatile quarter for the technology portfolio and for the year as well. The portfolio has a higher exposure to growth and small cap stocks versus even the MSCI All Country Investment Information Technology Sector Index, and this drove most of the underperformance. The managers here take a pretty high active share and focus on stock selection. On the back of this underperformance, you'll see that the portfolio actually rebounded pretty sharply in the first 5 weeks of the year. It's up 17.7%. Again, slightly more volatile, and there's a lot of stock selection here. They did outperform. They're continuing to stick to their guns here as well. Global real estate satellite portfolio, it eked out positive returns in the fourth quarter and ended a challenging year for property and infrastructure space in general. This one really suffered from sharp rate hike increases from the Fed as yields got driven higher, coupled with recession fears, prices were driven down lower. The portfolio has a slight growth tilt and some country-specific biases. This drove underperformance versus the benchmark and some outperformance this year as well. This is actually the second best performing portfolio year to date after the technology portfolio, so there's been a bit of mean reversion here as well. Finally, on the low volatility fixed income portfolio, it performed in line with expectations for fourth quarter and 2022. The underlying holdings moved together with the rally in fixed income on the back of news that possibility that inflation had peaked in the US. Okay, moving on to the income portfolios. So we offer 3 different diversified income solutions for investors at different stages of their lives. In varying levels of stable distribution payouts and different asset allocation mixes from low risk to higher risk. You can see those in the gray boxes over there, from 100% fixed income, 20% equity, 80% fixed income, 40% equity, 60% fixed income. There was strong positive returns across the board for the 3 Endowus income portfolios. These outpaced the positive returns of the broad fixed income of blended benchmarks. The drivers of outperformance varied really between the different portfolios. Some attribution came from individual manager outperformance. Some came from geographical overweights to Asia, emerging markets in the case of stable income, or even high yield in the case of higher future income. In the case of future income and overweight allocations, European equities actually drove some outperformance. You can see their strong outperformance for the fourth quarter helped drive year-to-date outperformance for the 3 portfolios versus the broad benchmarks as well. Positive sentiment across these portfolios continues into the year. You can see their positive performance between 3.7% to 5.2% for the 3 different portfolios. And interestingly, the returns are kind of in line with the risks that your commensurate risks that you take within these portfolios. Importantly, the income portfolios continue to meet their payout targets, which are consistent high level of distribution yields, and these are not taken from capital. So we visualize the yields across the 3 income portfolios. Risk market volatility last year drove mark-to-market losses across the 3 different portfolios, but it did not affect the coupon payments or dividend distributions. In the case of equities, the yields have been stable and rising. So at the end of the year, you can see there, higher income was yielding something like 6.5%. Stable income was closer to 6%, having started the year closer to 4.5%. Future income is at 4%, having started the year closer to 3%. Interestingly, we've also seen some price appreciation for the underlying. I mean, they're up, as I mentioned, between 3 and 5% for the year. So there's been a bit of, kind of return of capital, return of price, and obviously the coupons are completely intact as well. Finally, on cash smart portfolios, we have 3 variants of our cash smart portfolio range with varying degrees of expected yields or returns and the commensurate levels of risk as well. All 3 portfolios posted positive returns for the fourth quarter. You can see those highlighted in the blue box. The ever-stable cash smart secure was up 1.6% for the full year 2022 on the back of rate increases. Cash smart enhanced and cash smart ultra recorded negative returns for the year, but they came back really strongly in the last 3 months of the year. So you can see there they ended the year down 42 basis points and down 2.8% respectively. As kind of a common theme as well, they're off to a pretty strong start for fixed income and for cash smart as well for the year. You can see there the last 5 weeks, they're up between 26 basis points and 1.3% as well. So it's really, really good to see a rebound in performance here. If we visualize this on the next slide, what you'll see here is a performance line chart of the 3 cash smart portfolios going back to the start of 2020, so 2 years. All 3 portfolios are performing in line with expectations of risk and return. We can see the strongest rebound in cash smart ultra, so that's in the green line over there. You can see there it had a bit of a sell-off in 2022 and staged a very, very strong rebound as well. On the next slide, the rising rate backdrop has driven yields move up substantially. So you can see there the figures. I don't need to read off the page really. You can see Ultra is yielding something like high 4%, Enhanced 4%, and Access of 4%, and Secure somewhere over 3% as well. And with that, I'll turn it back to Sam for further comments on a 2023 outlook and interesting takeaways on an FMC survey that we conducted.
Great, thank you, Sean. This is a new thing that we wanted to share with the audience. This year we went out to all of our major fund manager partners and got collated data on some of the most important forecasts for macroeconomic numbers. And we wanted to share that with the audience. So 60 plus fund management companies from the end of last year coming into this year, questions across various topics, outlooks and surveys. And the way to read it is basically we asked, the 2030 respondents or however many we got in the end, and we're still collating some of it, so we'll update this further. But the average number for, well, three numbers, 2023, 2024, and 2025 forecast, and this is for global GDP growth. And then what is the average of everybody, every respondent? And then what is the lowest one? Who's the most bearish? In 2023, there was a fund manager who's forecasting zero growth. And then who's the most bullish? One fund manager was forecasting 4.5% growth in 2023, but the average is 2.9, which is a flat number from 2022. The 2022 final numbers are not in yet because the economic data comes out with a lag, but it's estimated to be about 2.9. So it's about a flat growth, which is surprising to many people. But in fact, we're actually expected to see growth slow down even more in 2024, whereas it holds relatively steady this year. So there is no massive fall in growth globally, when we expect growth to slow down next year and then rebound in 2025. And if you look at the subcomponents of that, the first one is US, which is expected to slow down. So 2022 is expected to come in just above 2%. And we'll have to see the final numbers for that. But at the moment, it's about 2%. And people are expecting generally on average about 1.8% this year, which is a mild slowdown. So not a massive slowdown, not a recession. But what's interesting is that 2024 is when most people expect growth to slow down even further. And that's because, the consumer numbers are more robust, job data has been quite good, wage and pay numbers have been pretty good. And therefore there's this sense that consumers are holding up the economy relatively well because they have strong balance sheets coming out of COVID, and liquidity has been good. They think that 2024 will actually see the impact of the Fed tightening, and we'll see a more dramatic slowdown with the risk of recession actually higher in 2024 than 2023. And then after that, we'll see a rebound that some people think will be very strong. But the other side of that is China, because China last year showed very weak growth. We were expecting 3% in 2022. And now that we're out of the COVID lockdowns and the global trade is, starting to gain some momentum, Chinese growth, GDP growth is expected to accelerate to above 4% on average, and further accelerate to 4.7% next year. So China and some parts of the developed emerging market and developed rest of outside of US is actually holding up global growth. So despite US slowing down, global growth is expected to remain relatively strong. Now, the two other data points we collated data on was the US Fed interest rate. So there is an expectation that Fed interest rates probably will peak above 5%. But will average about at the end of the year closer to the mid 4% level. So we're not expecting a dramatic cut in Fed interest rates. And then we'll start seeing that coming down, not in 2024, but 2025, which was a bit of a surprise to us. But the minimum numbers keep coming down. So you see the minimum 4.3%. It's a very narrow range in 2023. And then you see 2024 and 25, a lot more dispersion in outlook. So there are people who are very bearish and expect interest rates to actually go up further, versus others who think that inflation will actually come down, and Fed rates will follow very rapidly. And I think that's kind of the outlook for the last number, which is US inflation. So 2022 closed out at 6.5%. So the average expectation for this year is relatively high, which is surprising because in reality, I think the numbers have already started coming down for CPI. And I think it's partly because everybody got this wrong over the past 2 years. And as a result, I think people are being very conservative because they don't want to look stupid again. So that may be one of the reasons why this is being a much more conservative number for 2023 and a very sharp drop in 2024. But there's also expectation in 2023. Some fund managers think that inflation may fall to as low as 3.2%. And I'll go into a bit more detail on what are the mechanics that will drive that. So if we look at the Endowus 2023 market outlook, I think obviously we still have to start with where the Fed is, where interest rates are headed. And I think that, we can clearly see that this cycle and why the fixed income market was impacted so heavily last year with mark-to-market losses in pricing, despite yields coming up, is because of this, that the Fed rate hike was one of the steepest in history since the 70s Volcker cycle. And the latest hike of 25 basis points takes us to the 4.5, 4.75% range. But we're expected to see at least 2 more hikes of 25 basis points, if not 3, which will take us to 5% and slightly above. And that's pretty much consensus view. And the thing is that the market actually has always predicted this and has moved faster. So the market has always moved before what the Fed actually does. So when people say, oh, isn't the Fed going to raise rates even more over the coming months? It doesn't really matter because the market has actually moved forward and priced that in already. What's important is that the market currently is expecting the Fed estimate at the year end, which is which is the Fed publishes every time they have their FOMC meeting, and they show those multiple yellow dot plots that we showed previously, and we took out this quarter because it was a bit complicated. But this chart exemplifies where the FOMC is guiding interest rates will be. So at the end of 2023, 5.1%. At the end of 2024, it will be 4.1%. But the market, the bond market and the fixed income market is actually pricing in a lower interest rate by the end of even this year, 4.6%, and will be meaningfully lower of 3.6% next year. So there is a little bit of a gap between what the Fed speak is saying. What Fed wants to do is rein inflationary expectations. They have to be hawkish, and they're talking a very strong, talk. Whereas the market is saying that, yes, we understand why you're doing that. We understand why you're saying that. Yes, there's a risk that inflation may surprise on the upside, and therefore this may happen. But the probability of this happening is probably lower. And the more likely scenario is that actually inflation comes down, and therefore the interest rates will either peak at a lower level or will peak at the right level and then start coming down sooner than we think. And this is really critically important to the markets and both fixed income and equities and how they do this year. So we've shown this chart before. And right now, this is the year-on-year CPI, core CPI chart, which is the most important, together with the PCE number that the Fed follows very closely. Now, the core CPI is a year-on-year number, but we track the month-on-month number as a momentum. And if we currently, right now, this is as of September. And so since that number was published in September, we're actually tracking at 0.2, between 0.2 and 0.4. So the light blue line and the dark blue line. So we have actually seen CPI continue to come down towards the end of last year, and probably we'll see that continue in January and into February with high base effect of January, February last year. And we'll probably be closer to 0.2%, if not 0.3%. Probably unlikely to be 0.4%, which means that we're on track for inflation to end the year at closer to the 3% range. So I think there is a path where CPI does come off relatively quickly. And if that's true, then the Fed will obviously have to adjust accordingly. Now, as a result of this, I think the biggest concern is now shifting away from inflation to growth. And one of the biggest prevailing downside risk and risk of, risk in terms of financial markets is that we actually see the Fed tightening more than they should. And as a result, trigger a bigger recession. And so that is the biggest concern in markets. But at the same time, what's happened in the recent couple of months coming into January, which is very different from where we were in December, and again, as we enter February, the markets are shifting again, is that actually the market is pricing in a lower probability of recession. The only thing that's predicting a higher probability of recession is the 5-year treasuries and the inverted yield curve. But the inverted yield curve is a result of the long end of the curve actually falling, not the low end of the curve rising. So I think that's really interesting. And most indicators of the market probability of recession is actually coming down. Despite that, the only concern that the market has is how strong the U.S. job market is. We saw a very high payroll growth, and we saw unemployment rate continue to fall to the lowest rate in 53 years. Some of this is people leaving the workforce. Some of it is a lack of immigration that's unique to the U.S. But regardless of that, the Fed is focused because they have a dual mandate of unemployment and also inflation. And they think that this high payroll growth and low unemployment rate could fuel further payroll growth and further inflation in the form of wage inflation. But in fact, everything else, whether it's housing to consumer, is starting to come off. And this is probably the last leg remaining in terms of US growth. And as a result, the market has started to respond to the Fed's, not so much the dovish signal, but the fact that we're probably reaching the end of the rate hike cycle. And so across equities and fixed income, from the trough to peak, we've seen a very strong rebound, mostly led by equities and especially emerging markets. Now, one of the biggest questions we receive, and this seems to have become a much more consensus view, is that fixed income looks much more attractive. Now, we showed the same cartoon picture a quarter ago and talked about how fixed income looks much more attractive. It has outperformed, and now it's becoming much more of a consensus view. And it's for good reason, because we have not seen these kind of high yields since 2009, so more than 20, almost more than a decade ago. And so absolute interest rates being high is nominal interest rates being high is very, very attractive, especially when we've seen such low interest rate environment for so long. The other thing is valuations for fixed income has really blown out to levels which makes it much more attractive. So the median level is the purple line, and current levels of spreads versus treasuries and versus their median is on the diamond blue dot. And obviously the spreads have started to narrow a little bit as fixed income has rebounded. But generally we're seeing that versus the 10-year average range, the current rates spreads are quite high and the yields are quite attractive across the board. But especially in emerging markets and the corporate space. And the other thing that we need to understand is that it's very, very, very rare for the bond market and fixed income to see 2 consecutive years of negative growth, negative returns. So that's what we've just managed to achieve. We had a negative return in 2021, and we had another negative return in 2022, and it was the biggest negative return in history. And so as a result, I think it's important to understand that this is abnormal and that the normal result is for bonds and fixed income to give us a positive return. And so 2023 is most likely going to be that year. When we move over to equities, people show a lot of these charts. This was one of the ones that really stood out for me because I think that, the Dimensional came up with this chart, and this is as of November. And so it was interesting. And right now it compares, to what the equity markets did in 1980, just after the oil crisis, where the markets went down by 20%, similar to what we saw last year, and then rebound and have a strong performance with inflation and interest rates coming down. Or is it going to be more like 2007-9, where we went into a disinflationary shock and the market continued further leg down over the next 100 days to reach a minus 40% number at the end of the year. So I think we're likely to see, more likely to be something in between. But so far, that brown line has actually tracked the blue line and the 1980 returns in recent months, if we update this number. Also for equities, I think that, unlike fixed income, it's not absolutely cheap. But having said that, versus history, we're now moving from expensive levels to average levels of valuation. And in certain markets like China and certain areas of emerging markets, also Europe, we're seeing valuations still remaining relatively low versus the US certainly and other markets in history. And this is one of the biggest questions that we face is, how does emerging markets look after their recent outperformance? Obviously, a very sharp reversal is probably unsustainable, and we'll see some volatility creep in. But from a valuation perspective, again, US has been outperforming the rest of the world, and especially emerging markets, for almost 2 decades now. So well over a decade. And so from a valuation perspective, whether it's seen in the earnings ratio or whether it's in the yield ratios, they look relatively attractive versus the US. And whenever we talk about the emerging markets, then obviously what the US dollar does is absolutely critically important, because a stronger US dollar pulls liquidity out of emerging markets, which experiences a short dollar phenomenon. So, when the dollar starts weakening, it actually pumps liquidity, either through the balance of payments mechanism or through more direct channels or financial channels. There's definitely an improvement in the liquidity and the financial conditions of emerging markets, which is a positive. And in that scenario of a weakening US dollar, it's probably a lesser headwind for emerging markets to continue to outperform. The other thing is that the 60-40 portfolio, again, this chart we showed in the last quarter, showing that 60-40 portfolio returns were at the worst in history since 1927. And compared to other types of portfolios like 25-25-25, it was actually also one of the worst since 1970s. So I think the contrarian trade, which turned out to be the right trade since then in the fourth quarter, and again this quarter coming into this year, is to actually be long 60-40 or any form of balanced portfolio. It could be 50-50, it could be 40% equities and 60% fixed income, because we have high conviction in fixed income than equities. Whichever form of balanced portfolio it is, it seems like we'll continue to see that portfolio do well in 2023. And the reason is because historically, it's a statistical number. Since 1926 to 2022, whenever the 60-40 portfolio declined by 10% or more, what did that portfolio do in the next 12 months, 3 years, and 5 years? In the next 12 months, after a 10% or more decline, the 60-40 portfolio on average returned 7.9% in 1 year. And then over 3 years, cumulatively 17%, and then over 5 years, 37%. So a decline of 10% or more is rare, but when it does happen, the more likelihood is that it will generate good returns over a longer period of time. The other thing that we wanted to highlight is that this, intra-year decline, because markets are volatile, and we need to take risk in order to generate the returns we need to get. But trying to time the market or trying to time the bottom of the market is very, very difficult. And trying to, not letting our emotions get ahead of ourselves is really critically important for long-term success. So every single year, we see a period where the market declines intra-year into negative territory. But almost every single year, 2/3 of the time, the markets end up being in positive territory. So even this year, we had a period of -3%, but actually year to date, we're 8%. And most of the times, the annual return is better than the intra-year bottom of the market. So there is a case to be made that whenever the market corrects, we should stay diligent in our monthly recurring savings or dollar cost averaging, because those are the right times to continue to commit our capital to build wealth over the long term in the right way. But also, it's important to behaviorally not worry about what the market does and continue to save and invest into financial markets, because over the long term, it's the only sure way to have success. So with that, I'm gonna do a quick plug for the next webinar on this Friday. Next Friday. It's a lunchtime webinar again. Sean is going to be very busy. He's doing this, and then he's going to do this one together with you, Lynn, because we had a lot of requests about the Endowus income portfolios. Going into a bit more deep dive, I think Sean mentioned a little bit earlier, but we're seeing the Endowus income portfolios continue to provide income, the passive income, the dividend payout, the yield coupon payout, so that the payouts, even though the portfolios have actually been suffering from mark-to-market impact, has actually continued to give us the right payouts. But the yields have continued to go up, even despite the payouts, and the markets have actually rebounded. So we're getting capital gains from the rebound this year and from the fourth quarter, and we're getting higher yield. So it actually is a double positive. And so the Endowus income portfolios is built in the right way, with the three options that we have, with the different asset allocations for different needs, and different risk appetites. So please join us next Friday, or if you cannot join, please subscribe to the Endowus YouTube channel so that this will pop up automatically, and then you can listen to it in your own time whenever you can. So please join Sean and you, Lynn. And then the last plug, obviously, is the Endowus 2023 Market Outlook, which, if you joined us late, happened a few weeks ago. The content is amazing. We have like every single major global macro, BlackRock, PIMCO, Amundi, T. Rowe Price, Wellington Partners Group, and a lot of great speakers from some of the leading fund management companies joining me, Sean, Min, and Jamie, speaking about some of the most pertinent questions. So please also check that out whenever you can. And finally, we have a wonderful group of client advisors who are here for you. Please join the Experience Endowus session, which is hosted every Friday at 12 p.m. during your lunchtime. And you can always schedule a session with your client advisor. So please reach out, and have any questions, then please direct them to our client advisor team at support@endowus.com. The details again are in the description in the YouTube channel. With that, we're going to go to Slido. Sean, if you see anything.
Yep, I'll flag it for you, Sam. Thank you for
No,
the
or
plug.
you can answer it as well, Sean. Whatever.
Yeah, I think it's for you on the markets.
Okay.
Here's
Let
the
me take
question.
the first one. The highest one,
Yeah,
voted one, is
exactly.
year-to-date markets have rallied from Tesla, Meta, China stocks, all above 50%. Very accurate. Should we be worried of big pullback, start to take profit from portfolio, transfer to money market? So I think the approach that we have is two things. One is that asset allocation drives returns. So yes, single stocks and certain sectors and certain geographies outperform, but overall asset allocation to equities versus fixed income, to money market short term versus long term investment, is how we kind of frame it. The second thing is that we want to be passive and strategic in asset allocation, because that's the only way that we have peace of mind, certainty of growth over the long term, and reduces the risk. And we can dollar cost average into that portfolio over the long term. And what we espouse, most importantly, is being goals-based investing. So what are you investing this pot of money for? Is it to grow wealth over the long term? Is it to build a retirement pot? Or is it to conserve capital? So the purpose of investing is the most important thing. So money markets is a product that currently is yielding negative real returns. So if you take out what inflation is doing, then it's still, despite money markets giving you 4%, it's still giving you a negative real return. So it's not the right way to grow wealth over the long term. It's purely for capital preservation, or it's for getting some yield for your cash while you wait to deploy it either in investments or to spend it somewhere. So I think we need to understand what the money is for. Now, once again, going back to that chart, it's very difficult to time the market, because I think we have to have humility that we cannot predict the future. No one would have predicted last year being such a bad year after such a good year in 2021. No one would have predicted the market to rebound so quickly since COVID. No one would have predicted like this rebound that we saw recently after a terrible year last year. So it's very difficult to predict, whether after 100% rebound, Tencent will go higher, whether the tech after rebounding so much will correct. But what I would say is that being diversified reduces a lot of that risk. So for most investors, for 90% of you out there, I think the right way to go is to have a globally diversified portfolio and have the right asset allocation that is appropriate for your risk and appropriate for your goal. And then for the 10%, like I think the investor, if you want to time the market, then you play that core satellite. You have that core allocation so that you don't touch that piece, but you have a piece of satellite allocation, maybe it's 10% or 30% of your portfolio, where you can actually, exhibit some form of active allocation to say that, hey, technology looks good here, that we should deploy to technology, or we should deploy to China. And maybe, after a strong rebound of 20%, in a month, then maybe we should trim some. So there's ways that we can trade within the portfolio, with individual funds or with our satellite portfolios, that is still consistent with the level of risk and the goals of investing that you have. But I think that it should be separate from the core portfolio allocation that you have within Endowus. So I hope that answers the question. Passive NASDAQ funds. So our technology fund portfolio is a much more broader exposure, but it actually tracks the NASDAQ performance quite closely in terms of correlation. So you can see that actually it fell quite a lot and then it rebounded very short. It's up 17.7%. It's quite a lot. So I think that if you want to have exposure to NASDAQ passive index fund purely because you want beta to the technology sector, then I think you can gain that exposure through the Endowus technology portfolio. Or there are individual technology funds like the BlackRock Tech Fund and other tech funds, which represent a good exposure to specifically NASDAQ being US technology. Then there are funds that could be more suited to that. NASDAQ passive index funds will take your feedback. I think we have looked at it in the past, but Sean and the team will review and we'll come back if and when that becomes ready for you to invest in. So thank you for that question. ESG portfolio, I think our investment team have replied to some of that, but invariably, I think that some of our portfolios that are more concentrated in nature, which are not globally diversified, which are not more passive, those will naturally be a slightly higher volatility, whether it's ESG, whether it's technology, whether it's China, obviously versus the index. I think there was another question about how the satellite portfolios always compare versus the benchmark. One of the reasons is because it's very difficult to select the right benchmark. So for example, China equities is not truly just pure China equity because there's China A shares onshore, China H shares offshore, there's B shares, there's Taiwan and Hong Kong markets as well. So is it greater China or is it core China? Is it local, domestic, or is it external? There's US listed stocks as well, much less so now. But we decided to create a lower volatility China portfolio. So I think it's really important to understand what you're buying, why Endowus built it the way we did, and then make sure that you understand the nature of the portfolio, whether it's higher volatility versus the benchmark or low volatility versus the benchmark. But every portfolio is supposed to be strategic in asset allocation and passive in the way we run it. Hi, Sam. Should I allocate 100% to fixed income for flagship for this year? So I think that I kind of answered that somewhat in the answer to, needing to invest according to your risk appetite and according to your goal, right? If you believe that you will be worried if equity markets are volatile and you want to stick to a 100% fixed income portfolio, that is what's suitable for you. And I think at this point in the cycle, fixed income markets actually look very attractive. But over the longer term, in building wealth and especially preparing for retirement, where we're investing for 20, 30, or 40, 50 years, really long periods of time, then actually fixed income is probably not enough, because we may have a strong rebound and have one great year or maybe even two great years. But over the longer term, fixed income will underperform equities. So your argument would be, hey, I'm going to be in fixed income. After a great return, I'm going to shift to equities. That may be a good strategy. But it could also mean that when the fixed income market rebounds by 10% and we think we did fantastically well, equity markets might rebound by 20%. It will be kicking ourselves. So that's why the beauty of the balanced portfolio, whether it's 40-60 or 60-40. And I would say that, hey, then, for somebody who is very biased towards capital preservation, is a bit risk averse, has a decent exposure, but not 20, 30 years of time ahead of them, and they're maybe in their 50s like me, or closer to retirement, then yeah, maybe have a higher fixed income allocation, but don't go zero on equities, because you don't know. Over the next 5 years, equities may outperform fixed income. So I think that maybe go with a 20-80 portfolio, so 80% in fixed income, or 30-70% portfolio. And I think that's enough. Having a balanced portfolio always gives us peace of mind, knowing that we're in the market, but we're not overexposed. So, and also in the worst case scenario, if everything goes, downward, there's a World War III, whatever, obviously we'll have to pull out our money. But in that kind of a even bad scenario, we see another 20% fall in equities. If you're only 30% exposed or 20% exposed, that's 20% fall of 20%, so 4% fall in loss, absolute loss. If you have a 30% equity allocation, that's a 6% fall if the equity market goes down by 20%. So it's not as big, it's not going to really wipe you out, and you'll have an opportunity to regain that over the cycle and over the long term, because equity markets always goes up over the long term because it gives you exposure to some of the best companies in the world. And so while there's volatility, there is an upward skew towards the top right, where equity markets will eventually go back to the norm, and the long-term average returns of 5 to 7, 10%, depending where you started. Okay, I think we are on the full 1 hour, but is there any question that we need to take, Sean, or you'd like to address?
No, I think we covered all of them, and then there's the investment office has fielded the rest.
Yeah. So thank you guys for joining us. Please join us for the again, going back to the Endowus webinar that's upcoming on Friday. Endowus Income Portfolios is some of our most popular portfolios on the platform. We've taken our time to build the most appropriate allocation for that. We have the stable income for slightly older people, 100% fixed income, generating now 5% plus yields. You have higher income for people like me and Sean, I guess, the sandwich generation, supporting our parents and also our children, and expecting a higher payout. So slightly more risk, 20% equity, 80% fixed income, generating yields up to 5-6% plus. And then you have the future income, which allocates for the younger generation, 20s and 30s, where some income would be great, but we're probably targeting 4-5%, and that's come up from 3-4%. And you have a 40% allocation to equity. So over the long term, you're actually building capital, and that capital growing means that you'll have more income paid out in the future. That's why it's called future income. And so stable income is really not losing money, not taking money out of your capital, and really continue to get passive income. Higher income is people who need income right now, but we offset it with a higher some allocation to equity, which will grow. And then future income, which is equity 40%, which will grow capital, but you'll get consistent payouts of 4-5% as well. So yields have continued to go up. I don't know if you can see it, 4.5, 6, and 6.5% on the slides. And I won't be able to join, but we have amazing speakers, Sean and Yulin, who help to build the portfolio and manage the portfolios here at Endowus, leading the charge on that one. It's at lunchtime this next Friday, so please join us. Otherwise, please subscribe to the YouTube channel, Endowus channel, so that you'll be notified when this happens, so that even if you can't join us live, you can watch it at a later time. So please check out all the great content that we have on the Endowus YouTube channel. And that leaves me to thank you for joining us tonight. Have a wonderful evening. Stay well and healthy. Continue to invest and stick to your investment plan. Please continue to spread the good news and the word about Endowus and how great the platform is. And also, please join us for the Endowus Income Portfolios webinar next Friday. Thank you and good night.
Thank you.